Well, today I quickly want to talk about seasonal and calendar anomalies. Now, I do have other videos in this series, which you can watch by following these links right here. The question of today is whether or not there is seasonality in stock returns. Now, in a previous video, I talked about InBev, and I wanted to see if there's any seasonality to their stock returns, thinking that, hey, maybe the returns leading up to the summer would be better than average, and the returns following the summer would be better than average, given that the company sells a lot of beer in the summertime because that's when people consume it on average. Well, it turns out that is correct. In June has the best returns here at 2.4%, and October has the worst returns at negative 2.73%. I also said, hey, what about the 4th of July? Is there anything associated with the 4th of July, given the consumption patterns around the 4th of July? Yes, find something here too. On average, InBev's relative return to the market is negative 1 basis point, but the day prior to the 4th of July, we see a positive 46 basis point return on average, and the day after we see a negative 19 basis points return on average. Now you can watch the full video, the full details here if you want to by following this link right here. The question is this true with other stocks? Here is Intel. We see, if you want to learn how to read this, so here we have 84% of the time, Intel has a positive return in the month of April to the tune of, on average, 6.3%. Now, keep in mind, this is not relative to a market. It is also not associated with a thesis, right? I don't know why Intel would have better returns in April and October and worse returns in September. Now, with that InBev analysis, I came up with that prior to looking at the data, and it just happened to match my intuition, even though that should already be built into the price, which is kind of where the anomaly comes in. But these things can be relative. So here's a chart. This is the Russell 2000 versus the S&P 500. These are relative returns. We can see, in terms of months, December is good for small caps and October is bad for small caps. Now, we can do this kind of for the stock market in general, and we see, hey, here's some patterns here. Clearly, January, October, December are the better months for stock returns. And I threw a T-stat in there, right? So, but also keep in mind, that 1.96 would be the 95% confidence level for a T-stat. But again, that's for only one observation. I talk about that in these videos right here. Really, given the massive quantities of testing we've done, we really should bump that T-stat up to about 3. But we still see December, October, April, and January are all very significant in terms of these results. Going back to the InBev example, what if we did that for individual stocks? There is some research out there that shows that there are seasonality involved in stocks. So here, we kind of take the best month for stocks and then lag it, and we see here all those circles. That's like the 1 year falling, 1 year falling, 1 year falling. So we see that stocks on average, given their own month, have whatever month it is, the best returns. And we see that just over and over and over again. Now, the question is it really stocks driving this, or is it underlying style factors driving this? The authors here in this paper say, look, it really is, in their opinions, it is the underlying characteristics, the style of these stocks that are driving it. So they looked at size, value, momentum, dividend to price, and industry portfolios. And again, they saw these patterns where kind of once a year they hit this golden time of year in terms of a 1 month period. We also here in this research looked at weekly returns, or the day of the week. So again, if you kind of highlight the best day of the week for a particular stock and then lag it, you find that it just keeps hitting back on that date again where the returns are superior over time. Now, keep in mind, none of these things here have that thesis that we're talking about. So take this all with a grain of salt, but we do definitely see seasonality in stocks month by month, and then day of the week by day of the week. Now, that's it for today. As always, happy trading out there. I'm Brian Kozlowski. I hope you enjoyed that. Thank you so much.